Most people do not break the laws of money because they are stupid. They break them because every single part of modern life is engineered to reward the violation. The bank smiles and gives you a higher limit when you borrow more. The dealership pats you on the back when you stretch the payments over 6 years. Your coworkers nod approvingly when you pull up in a newer car. Social media explodes with likes when you post the vacation you could not really afford. And when the bill finally comes due, everyone suddenly acts shocked and calls it a personal failure. That is the ugly truth nobody wants to say out loud. The average man is not just fighting his own bad habits. He is fighting an entire incentive system designed to make terrible financial decisions feel completely normal, even responsible, even adult, even smart. A bigger car feels like progress. A higher credit limit feels like trust. A mortgage approval feels like achievement. A promotion feels like freedom. But sometimes all four are just different ways of tightening the same invisible collar around your neck. This is not another feel-good video about 7 cute rules to become rich. This is about 7 laws that most people violate quietly for years, until one day they wake up and realize their income went up, their stress went up, their obligations went up, but their freedom never moved an inch. And by then, the damage does not look like one big dramatic mistake. It looks like a perfectly respectable life. The first law people violate is this: money loves speed, but wealth loves time. The real mistake is not moving too slowly. The mistake is expecting 6 months of frantic action to erase 10 years of rotten structure. A man spends a decade ignoring his finances, then suddenly panics and demands the universe reward his new urgency. He wants the psychological relief of finally doing something without ever paying the brutal cost of patience. You see it everywhere. A guy finally stares at his credit card balance at 2 in the morning and has an emotional awakening. He attacks the debt aggressively for 3 months, then gets furious when he is still not free. But that 22% interest does not care that he finally woke up in March. It has been compounding against him every single day he was distracted, scrolling, and telling himself next month. His sudden seriousness is good. It is not magic. This is exactly why people become easy prey for financial shortcuts. They are not always greedy. Often they are embarrassed. The gap between where they are and where they think a man their age should be feels humiliating. So when someone offers speed, they do not hear risk. They hear dignity being restored. That is how bad investments and get-rich-quick schemes get sold to tired, ashamed men every single day. The violation is brutally simple. People move too slowly when speed actually matters. Waiting years to confront debt, raise income, learn investing, stop lifestyle creep, or admit that their financial structure is weak. Then, after delaying every hard decision, they suddenly demand wealth to appear overnight. They want the harvest without ever respecting the seasons. Here is the painful, concrete consequence most people refuse to face. If a man invests $500 a month from age 30 to 65 at a 7% annual return, he can end up with roughly $900,000. If he waits until 50 and invests the same $500 a month until 65, he ends up with roughly $150,000. Same habit, same monthly sacrifice. Completely different life. Time does not forgive late starts. It punishes them quietly. And that is why Law 1 is not motivational. It is accusatory. It forces you to ask where exactly you are still moving too slowly because the consequences feel distant. It forces you to ask where you are demanding speed because you are ashamed of how late you started. Money rewards fast correction of mistakes. Wealth rewards long, boring endurance. Most people reverse those two, then blame the system for being unfair. But once you violate the law of time, you become even more vulnerable to the second law people violate. He who gives the money has the power. Most men learn this too late because the regular paycheck does a brilliant job of disguising dependency as achievement. You get paid every 2 weeks and it feels like proof that you are in control. But structurally, the person who signs the check is the one who defines the game. He defines your hours, he defines your title, he defines what behavior is acceptable. He defines whether your family can take that vacation in July. He defines whether your labor is still useful after a strategy meeting you were never invited to. And if the spreadsheet says your role is now redundant, your years of loyalty become nothing more than a paragraph in a cold severance email that lands on a Monday morning. This is not anti-job. A job can be a very useful tool, but a job becomes dangerous the moment a man mistakes cash flow for sovereignty. He thinks 6 figures means power. But if one executive decision halfway across the world can cut off his income, freeze his health insurance, and force him to explain himself to another hiring manager, he does not have power. He has temporary access to someone else's money machine. This is why buy and build matters so much. If you cannot build a business yet, buy small pieces of other people's businesses. If you cannot buy much yet, build your earning power aggressively. If you can build a client base, build it. If you can build a product, build it. Because the man who only receives money must remain pleasing at all times. The man who owns claims on the output starts to negotiate from a different position. Look at the average high earner who never buys a single productive asset. He makes good money, but every single dollar arrives through permission. Permission from an employer, permission from a client, permission from a platform. The moment that permission changes, his entire lifestyle is exposed. The car payment does not care that his industry slowed down. The mortgage does not care that his company restructured. The private school tuition does not care that his manager changed priorities overnight. The violation of law 2 is believing that higher income automatically creates real authority. It does not. Income only creates options if some of it is ruthlessly converted into ownership. Otherwise, income simply creates a nicer, more expensive cage. The furniture gets better, the neighborhood gets better, the restaurants get better. But the basic dependence remains completely untouched. The painful truth is that many so-called professionals are not building wealth. They are renting status from their employers. The title, the apartment, the car, the confident smile at dinner parties, all of it depends on the next deposit clearing. Miss 3 paychecks and the entire identity starts to crack. That is not ownership. That is a costume paid for in monthly installments. And once you are trapped inside that dependency, you become extremely vulnerable to the third law people violate. Leverage multiplies everything. Everyone loves the upside of leverage. Almost nobody wants to admit what it is actually multiplying. Debt makes a strong structure stronger. It makes a weak structure collapse faster and harder than anyone imagined. The same loan that helps a disciplined operator buy a productive asset can turn an insecure man into a well-dressed prisoner with no escape route. The modern economy has gotten extremely good at selling leverage as simple lifestyle access. You do not need $70,000 cash for the truck. You just need the monthly payment. You do not need to truly afford the house. You just need to qualify. You do not need to own the latest phone. You just need 24 easy installments. The system learned that people resist big prices, but happily accept small monthly wounds that bleed them slowly for years. A $50,000 car financed at 9% for 6 years is roughly $900 a month. Over the life of the loan, that is almost $65,000 before insurance, gas, repairs, and depreciation. And because those payments come from after-tax income, a man in a 30% effective tax bracket may need to earn more than $90,000 just to feed one identity purchase. But nobody at the dealership leads with that number. They do not say, this truck will consume more than $90,000 of your gross income before it is even done depreciating. They say, it is only $900 a month. And you sign because by that point, the math is no longer negotiating with you. Your shame is. This is the social trap in full effect. A man does not just buy the car. He buys relief from the feeling that he is falling behind. He buys the look on other people's faces when he pulls up. He buys a temporary cure for the suspicion that he is not doing as well as he should be. The lender does not have to manipulate him much. His own shame does most of the heavy lifting. Leverage is not only debt. It is any force that allows small input to create large output. Employees, software, media, reputation, capital. But the moral character of leverage always depends on the base underneath it. Attach leverage to a valuable skill and it can build an empire. Attach leverage to insecurity and it will quietly finance your own self-deception for years. This is why two different men can use the exact same debt and get opposite outcomes. One borrows to buy equipment that immediately increases his business capacity. The loan is tied to production. The other borrows to upgrade his image because he is tired of looking average. The loan is tied to ego. Both men will tell you they are using leverage. Only one of them is actually building an engine. The other is building a cage with leather seats. The painful consequence of violating Law 3 is not always loud bankruptcy. Often, it is the quiet loss of maneuverability. Debt turns future income into pre-assigned income. Before the paycheck even lands in your account, large pieces of it already belong to the bank, the lender, the credit card company, the dealership, and the lifestyle you were desperately trying to prove. The money arrives already surrounded and claimed. That is the hidden cruelty of bad leverage. It does not always ruin you with a bang. It narrows your life quietly. You stop taking smart career risks. You stop negotiating hard for better terms. You stay in jobs you hate because the payment calendar is stronger than your courage. You call it being responsible, but often it is just leverage disciplining you for an ego decision you made years earlier. And when your life is narrowed by bad leverage and dependency, you start obsessing over the fourth law people violate. Cash flow keeps you alive, equity makes you free. Most people worship income because income is visible. It hits the bank account every month, it impresses relatives, it makes dinner conversations easier. But income that never becomes ownership is just a more elegant, more expensive form of survival. This is where high earners get quietly humiliated by the math. A man can earn $200,000 a year and still be financially fragile if his lifestyle costs $195,000 a year to maintain. His income looks impressive on paper. His surplus is pathetic, and real wealth is never built from raw income. It is built from the gap between income and consumption that gets ruthlessly converted into assets. The culture is expertly designed to close that gap for you. Get the raise, then get the better apartment. Get the bonus, then replace the car. Get the promotion, then move to the neighborhood where everyone else with your title lives. The system does not need you broke. It only needs your surplus absorbed. As long as nothing remains, ownership never begins. This is why cash flow alone is not enough. Cash flow pays bills, equity changes the relationship. Equity means you own part of the machine, a business, a portfolio, a rental property, intellectual property, a share of productive enterprise, something that can generate value without asking your body to show up every morning. But people avoid equity because equity feels slow, abstract, and emotionally unsatisfying. $1,000 invested in an index fund does not impress anyone at the office. $1,000 spent on a weekend trip creates photos, stories, and social proof. Ownership is quiet, consumption performs. And modern life rewards performance long before it rewards freedom. The painful consequence appears after a decade. The man who spent everything has memories and payments. The man who converted surplus into assets has claims. At first, the difference looks small. After 10 years, one man has a lifestyle he must keep feeding. The other has a financial base that begins feeding him back. This law exposes a brutal question every respectable adult should ask himself. Do you own anything that would keep paying you if your employer stopped tomorrow? For many, the answer is almost nothing. They own clothes, furniture, subscriptions, maybe a financed car, maybe some home equity they cannot easily touch. But productive ownership, the thing that slowly separates labor from survival, is tiny or absent. And once you have no real equity, you become terrified of any real risk. Which brings us to the fifth law people violate. Risk and reward are non-linear. Most people think risk is like a staircase. Take one step higher, get one step more reward. But real risk has trapdoors. You can be fined for years, then one bad exposure sends you straight through the floor. That is why the goal is not to win one big time. The goal is never to lose the game. This is where successful people become dangerous to themselves. A few wins convince them that the process is safer than it is. They bought a stock and it went up. They bought real estate and the market rose. They used debt and nothing exploded. So they confuse a favorable environment with personal genius. Then they increase the bet right when humility is most needed. Risk does not always announce itself as risk. Sometimes it looks like certainty. Everyone you know is buying. The chart has only gone up. The neighborhood is hot. The friend who got in early is bragging. You start feeling stupid for being cautious. That feeling, the fear of looking stupid while others get rich, is one of the most expensive emotions in finance. Nonlinear risk means one mistake can erase many good decisions. A man can save carefully for 8 years, then co-sign one bad loan for a relative at the kitchen table while his wife watches nervously and damage everything. He can build a portfolio for a decade, then panic sell during one crash and lock in the loss. He can run a profitable small business, then personally guarantee a $300,000 expansion loan, watch revenue drop 20%, and turn a business setback into a household crisis. This is why survival is not cowardice. Survival is the foundation that allows compounding to continue. The person who avoids ruin may look boring for years. He may miss a few spectacular wins. He may watch reckless people pass him temporarily. But when the cycle turns, the boring person still has capital, credit, reputation, and sleep. The reckless person has explanations. The violation of Law 5 is building a life that only works if nothing goes wrong. No emergency fund. High fixed costs. Concentrated investments. Variable income. Fin insurance. Debt attached to depreciating assets. On a good month, it looks efficient. On a bad month, it becomes a machine for humiliation. And when you are living inside that fragile structure, you become extremely tempted by the sixth law people violate. Do not bet the empire for a pot of gold. This is the law ambitious men hate the most because it sounds like it is attacking courage. It is not. It is attacking poor sizing. The opportunity can be genuinely good and the bet can still be insane. Every cycle produces the same man. He has finally built some stability, maybe $80,000 saved, maybe home equity, maybe his business is finally working. Then someone shows him an opportunity wrapped in the language of scarcity. Limited spots, insider access, ground floor, serious people only. The offer is engineered to make caution feel like weakness. He does not want to be the timid one. He does not want to be the guy who missed out. He has watched others win and feels that life owes him acceleration. So he puts half his liquid net worth into one private deal, one crypto position, one friend's business, one concentrated stock, one thing that could change everything. And it does change everything, just not always in the direction he imagined. The deadly question is not, can this work? Many things can work. The real question is, if this fails, what else dies with it? Does your emergency fund die? Does your marriage absorb the stress? Does your retirement timeline reset by 10 years? Do you become the man explaining to his family why one exciting opportunity consumed 10 years of boring discipline? Professionals separate risk capital from empire capital. Risk capital can chase upside. Empire capital protects the base: housing, liquidity, insurance, taxes, payroll, survival, and sleep. The amateur mixes them together because he wants one big win to erase the slow work. That desire is exactly what makes him vulnerable. This law is especially hard for men because money is tied to identity. Saying no to a big bet can feel like admitting you are small, but the market does not care whether you looked brave at dinner. It only cares whether your balance sheet can survive the outcome. Ego wants the story, wealth wants the denominator protected. The final law people violate is that diversification is a hedge against ignorance. The phrase sounds simple, but people use it to flatter themselves. They say diversification is for people who do not know what they are doing. Sometimes that is true, but most people who say that also do not know what they are doing. They just prefer the emotional intensity of concentration. Concentration feels intelligent because it creates a strong opinion. One stock, one asset class, one sector, one country, one business idea. It gives the investor an identity. He is not just investing, he is a believer. And belief is intoxicating because it turns uncertainty into belonging. Suddenly he has a tribe, a thesis, a villain, and a future where everyone else was too blind to see what he saw. But if you do not control the asset, concentration is often just confidence without authority. You do not control management. You do not control regulation. You do not control interest rates. You do not control fraud risk. You do not control whether the market keeps loving the story. You are not the pilot. You are a passenger with strong opinions about the cockpit. This happens constantly with company stock, hot sectors, and assets people think they understand because they use the product. A man works at a famous tech company, sees the stock rise for years, and lets half his net worth sit in the same company that also pays his salary. He thinks he's being loyal. In reality, he has placed his job risk and his investment risk on the same ticking bomb. If the company stumbles, he does not just lose money. He may lose the paycheck and the portfolio in the same quarter. Diversification is not glamorous because it admits, I could be wrong. That sentence is too painful for many people. They would rather risk being ruined than admit they are uncertain. So they disguise ego as conviction. They tell themselves they are concentrated like great investors, while ignoring that great investors often have access, control, research depth, deal terms, and emotional discipline that they do not have. The correct place for concentration is where you have real control, your skill, your earning power, your business if you can influence the outcome. But when your passive capital enters assets you do not control, diversification is not cowardice. It is an admission that the world is larger than your thesis. The painful consequence of violating Law 7 is not just losing money. It is realizing that you were not investing in an asset. You were investing in the story you wanted to be true. That is why concentrated losses hurt so deeply. They do not just damage the account, they damage the identity. The man does not say, "My position failed." He says, "How did I not see it?" Put all 7 laws together and the picture becomes deeply uncomfortable. Most people are not broke because they never heard good advice. They are broke because violating these laws gives them something emotionally useful in the short term. Speed gives relief. Salary gives identity. Leverage gives status. Cash flow gives comfort. Risk gives excitement. Big bets give hope. Concentration gives belonging. That is why people continue doing it. Not because the math is hidden, because the emotional payoff is immediate and the financial punishment is delayed. The car feels good today. The payment becomes suffocating later. The big house feels validating today. The fixed cost becomes a prison later. The concentrated bet feels heroic today. The loss becomes humiliating later. The financial system does not need you to be irrational all the time. It only needs you irrational at the exact moments when contracts are signed. At the dealership, at the mortgage office, inside the brokerage app, during the hot market, during the panic, during the promotion, during the dinner where everyone else seems richer than you. And that is the real trap. The laws of money are not violated in one dramatic scene. They are violated in small, socially approved decisions that make you feel normal. You stretch the loan a little. You upgrade the lifestyle a little. You delay investing a little. You concentrate the portfolio a little. You ignore the downside a little. Then one day, there is no little left. So the question is not whether you know these laws. Knowing is cheap. The real question is, which violation is still giving you emotional comfort right now? Which payment makes you feel successful? Which risk makes you feel alive? Which story makes you feel smarter than everyone else? Which lifestyle are you financing because you are afraid of looking average? Most people will never answer those questions honestly. They will keep calling pressure ambition, debt strategy, spending self-care, concentration conviction, and dependence security. They will keep polishing the outside of a financial life that is hollow underneath. And when the structure finally cracks, they will say nobody warned them, but the warning was there the whole time. It was hidden inside the laws they kept violating because the violations felt so damn good.